Hi everyone. It's been a somber few days here in New York. It's been raining absolutely solidly, and of course we had Yom Kippur yesterday, which ended at sundown yesterday. And of course, with the market now back to normal activity, we've seen a pretty aggressive sell-off, but it's still holding very well in oil prices. And while refining is wobbling, what we're looking at is wobbling from exceptional high levels to high levels. And of course, as we get into Q4, the oil price and refining environment remains very strong. So we're looking at significant earnings upgrades from particularly in refining, but also in the upstream side of the big oils. And as we highlighted in our Sunday note, as a result of the very low multiples that the oils trade at, we're looking at pressure upwards on the stocks, particularly now that they return excess cash directly to you. Essentially the move that we saw from mid-70s before Q3 into the mid-90s over the course of Q3 really does accrue back to shareholders in terms of extra money back in returns, and so equity values get forced higher from their very low multiples, and that's what we expect to happen as the earnings estimate upgrades come through. One company where we expect particular pressure upwards on earnings is Exxon. We met the company in Houston this past week. Everything's going very well. The mood in the company very positive, very visibly positive. And of course, they were talking about tripling their earnings in their downstream and chemicals operations by 2027, where operations have increased in size and are performing much better than they had perhaps 5 or 10 years ago. So Exxon doing very well, and we think that people hesitate to upgrade earnings before the 8K from the company comes out at quarter end, which will be next week. And as a result, Exxon earnings upgrades are lagging a bit, as they are generally across the space, because most upgrades will happen as the quarter ends. And as noted, the very low multiples of the oils tend to force them higher when earnings upgrades come through, at a time when we're probably seeing earnings downgrades, I should say, risk across the market, and of course a really hard time for any companies that are pre-revenue or pre-earnings. They've been bad all year. Essentially the market's been driven by the Magnificent Seven multiple expansion, and of course that multiple expansion comes under pressure when we're in the kind of rising interest rate environment that we're in. Most of our big investors think that interest rates can go higher, and therefore there's going to be sustained pressure on the Nasdaq. And if oil keeps holding with Saudi control of the market, we can see a very good year end for oil. As we said, Q4 is very likely, almost certain to start very strong given the levels that we're at this close to Q3 ending. So we're positive on the oils into year end. 2024 becomes a different question, and one thing that we did highlight that most people didn't seem to pick up on was the Saudi oil minister saying that if Q4 oil balances are really as tight as some forecasters suggest, multiple million barrels a day of inventory draws, then Saudi, he said, hallelujah, will be able to produce more. So I think that tells you that Saudi's now essentially attained its price target, which we set at 95. We pondered whether speculators could drive the oil price from 95 to 100, but it would be a speculative push, not a fundamental push. And we think that once you get to 100, firstly, anyway, the oil equities don't participate. We showed that the XLE essentially stops going up. The XLE is the oil's ETF. Stops going up once oil gets beyond 95. It can go to 120 and the oil equities won't participate, because essentially at that point high oil prices become a major problem for high oil prices, and therefore the equities will not run with that move. However, if we do hold in this mid-90s Brent range, over 90 let's say for WTI, you're in a position where the oils are just making extraordinary free cash flow, and with improved strategies which essentially give you the money back eventually or immediately, and with the low multiples I mentioned, the group should perform very well relative to the market into year end, barring a major external event. We did have one of those with the Russian diesel ban, which was an upside shock, but I think the consensus is that's a fairly temporary measure, and Russia will struggle to absorb all that massive amount of diesel, million barrels a day of diesel that they export. So whilst it was a short-term pop in prices, I think on reflection, people consider the Russian diesel ban to be a temporary factor. As I said, additionally, the real driver of oil to mid-90s, Saudi, we don't think will want prices to go a whole lot higher. So essentially, you're maxing out on upside that wouldn't be reflected in the stocks anyway. You hope that we hold these levels in refining and the oil price, because that will be very positive into year end in a weak market. keeping in mind that, of course, the oil's balance sheets are very strong. So if things really do go to hell in a handbasket, they will be defensive. Not always the case, obviously, into recession, but we did see at the beginning of the global financial crisis, the strongest balance sheets, which were the oils, Exxon and Oxy, did outperform a major downturn in the market. And going forward, the strong balance sheets that we've developed in oil will be an additional positive for the group. Hope you have a great week. Cheers.